Hey guys, it is Julie here with JT Wealth. In today's video, we are discussing 3 blue chip companies that have performed great this year, but still have plenty of room to grow in the future. So let's get into it. All right, guys, welcome back and thank you so much for being here. Like I said, today we are taking a look at a few different blue chip stocks. Now, these are from well-known established companies. So yes, spoiler alert, I am not going to be sharing some unknown companies that are suddenly going to explode 500% anytime soon. But these steady growing, often dividend paying companies do deserve a spot in your portfolio. So in today's video, we're going to take a look at these 3 companies and what has helped propel some of their success this year and what catalysts we think exist for their continued growth in 2021, plus what analysts are saying for their expected price targets. And just before we get into all of that, this is your friendly reminder that if you enjoy today's video, make sure you hit that like button and leave your thoughts in the comments down below. Also, if you enjoy free stocks, don't forget to check out some of the links in our description. Right now, Webull is giving away 4 free stocks for signing up and funding a new investment account, so make sure to check them out. All right, now blue chip companies. So these are often profitable, well-established, financially stable companies. As a side note, the term blue chip actually comes from the poker table, where the blue chip historically always holds the highest value. Now, I know companies like these are not as exciting as some of the more speculative, high-growth, risky plays that we often see here on YouTube. But as I say when we discuss those riskier plays should only make up a small portion of your portfolio. The rest of it should consist of some of these more stable, predictable companies. Sure, they can be a bit more boring and they aren't going to suddenly shoot up by triple digits, but these all offer some pretty solid double-digit potential growth, and most come with a nice dividend as well. So the first company we are taking a look at today is Walt Disney. Trading under the ticker DIS, they are currently around $175 per share. Now, they have taken quite the ride here in 2020, as they had a big drop of about 40% in the first few months of the year with the pandemic, but has since then more than doubled and has ended the year with about a 25% gain. Now, the 2020 pandemic was a perfect storm for Disney's businesses, including their movie theaters and theme parks closed, sports seasons shortened and delayed, television and film disrupted, and even their cruise line having to dock for the better part of the year. So with all of this, Disney's revenues absolutely tumbled, and they even had to stop paying their dividend, which was the first time in over 40 years that had happened. But all of that was outshined by Disney's new streaming service, Disney Plus. Since launching in November 2019, Disney Plus has rapidly grown to 87 million subscribers worldwide, and Hulu and ESPN have added about 39 million and 11 million subscribers respectively as of early December. That's where Disney's future lies. And the pandemic, if anything, has given the company cover to accelerate its transition to a streaming-centric operation. The decision to debut big-budget films on Disney Plus was much easier made by the fact that movie theaters were largely closed in 2020. Millions of people worldwide who were stuck at home during quarantines and lockdowns turned to streaming services for entertainment, boosting signups. And the coming year will be an eventful one. The company will debut Star, a new international service in numerous markets in Europe, Asia, and Latin America, starting in February of 2021. It will include general entertainment programming similar to Hulu in the US. Depending on the country, Star may be packaged with Disney Plus and include sports content too. A price hike is also in the cards for Disney Plus next year, with the cost rising by $1 a month. Disney also unveiled an ambitious new goal at its Investor Day in December. The company expects to have as many as 350 million subscribers globally across all of its service within 4 years, when it could be spending $16 billion on new shows and movies to keep subscribers signing up and engaging. It also plans to bulk up its original content pipeline with 100 new titles each year, including 10 entrants each in the Marvel and Star Wars series, which should only accelerate the service's growth. Now, unlike Netflix, Disney is still valued as a mature company despite its growth potential in streaming, meaning that the stock could still tack on significant gains even as it's already at record highs. Now, as far as Disney's non-streaming businesses go, as we see the coronavirus vaccine rollout and the world hopefully return to somewhat normal in this next year, once the Disney parks can all fully reopen, we should see a big influx of travelers there from all of that pent-up travel desire. So that will be a big increase to Disney's revenues. As far as analysts go, there are 21 analyst ratings on Disney, and it comes in as a strong buy with 17 buy ratings and 4 holds. Now, the average price target is $180, which is just shy of a 3% potential upside. But if we take a look at the most recent price targets, which have been upgraded or reiterated within the last couple of weeks, they're all far north of that $180 price target and are actually all above $200. The high-end price target of $210 would be about a 19.62% potential upside over the next year. Next up, we have Walmart. Trading under the ticker WMT, they're currently at $145.97 per share. Now, as a major essential retailer, Walmart did not have to close its doors during many of the lockdowns during this pandemic, and instead they benefited from many shoppers flocking to their stores in order to stock their shelves. And they also benefited from an influx of curbside pickup and online ordering. Yet while the pandemic gave Walmart a major leg up, it was hardly the company's only area of focus. Walmart has continued to evolve, diversifying its revenue streams by expanding beyond its core retail segment and zeroing in on higher growth parts of its business. The company is hoping to be a partial owner in the social media app TikTok as it looks to attract younger shoppers online, while it also launched subscription service Walmart Plus, which, much like its recent partnership with Shopify, is a shot across the bow at Amazon.com. Now, the company has been moving further into both human and animal health, while its overseas investments like Indian e-commerce firm Flipkart have worked out well. Some analysts hypothesize that advertising could even be a key new catalyst. There are 22 analyst ratings on Walmart with 18 buys and 4 holds. The average price target comes in at $164.79 for just shy of a 13% potential upside. The most recent price target was an upgraded price from RBC Capital of $170 for about a 16% potential upside, and the highest end is $180 for about 23% potential growth over the next year. And last but not least, we have Microsoft. Trading under the ticker MSFT, they're currently just above $215 per share. Almost alone among the legacy tech giants, Microsoft has made a successful transition to cloud computing from its past focus on data centers and packaged software, and the shift paid off in 2020, with the stock up roughly 40%, soaring to a nearly $1.7 trillion market value. That makes it the second largest US-listed stock after Apple. Old Microsoft dominated the market for personal computer software with its Windows operating system and Office productivity suite. New Microsoft still develops and distributes both of those, but the real story is the company's decisive embrace of cloud computing. Microsoft is the most defensive way to play the red-hot cloud computing sector right now, as at the core of their company is their high-growth Azure cloud computing platform, which grew by 48% last quarter. Now, we're still in the relatively early innings of enterprises migrating their infrastructures to the cloud, and Microsoft seems well positioned as one of the big 3 US companies primed to benefit. Last year, Microsoft earned its bona fides as not just a second place player, but as a potential leader after it won the $10 billion Jedi Cloud contract from the Department of Defense. Cloud computing is a utility-like service that's also high growth, adding a terrific business to Microsoft's already impressive roster of enterprise software products like Office and Dynamics. Microsoft is also the owner of business social media network LinkedIn, code repository GitHub, and the Xbox gaming platform, which just released its first new console in 7 years. So these highly profitable growth businesses, along with a healthy $137 billion in cash on the balance sheet, makes Microsoft a highly defensive and growth stock all at once. Now, there are 23 analysts with ratings on the Microsoft stock, and it comes in as a unanimous buy. The average price target comes in at $250 per share, which would be about a 16.5% potential upside over the next year. Some of the most recent price targets all come in above that price. Our highest is $272, which would be about a 25% potential upside. So I'm sure I did not surprise you with any of these three companies, but I do believe that they remained solid, stable picks for any portfolio. Of course, I always love hearing from you guys, so make sure to leave a comment down below. Let me know your thoughts on these three stocks and what other blue chip companies hold a large position in your portfolio. Of course, these videos are never a suggestion to buy or sell any specific stock. They're only made for information and entertainment purposes, so make sure you're always doing your own research and due diligence before making any investment decision. If you made it all the way to the end of the video here, make sure you hit that like button and that you're subscribed to the channel too. Thank you guys so much for watching. I hope you have a fantastic day, and cheers.